Is Ashish Patil and I am Head Equity Products at Bandhan Mutual Fund. It is my privilege to host today's Ashish Patil and I am Head Equity Products at Bandhan Mutual Fund. It is my privilege to host today's session. We are pleased to have with us today Mr. Manish Gunwani, who is CIO Equities at Bandhan Mutual Fund. He brings rich fund management experience and an excellent track record of wealth creation for investors. Over the course of this call, he will be sharing views on the equity market outlook. Please note that at this moment all participants are in listen-only mode. Do note that this conference is recorded. There will be a Q&A segment towards the end during which you can ask questions by using the chat function. Please note that mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Sharing, forwarding, circulating, or otherwise making available to anyone is strictly prohibited. Without further delay, I would now like to invite Mr. Manish Gunwani to take the session forward. Over to you, sir.
Hi everyone. Thanks for your time. I hope I'm audible. Can someone confirm?
Yes, you are audible, Manish. You can go ahead.
Sure. Thanks. So welcome all. Basically, we'll take about 20 to 30 minutes just talking about our market outlook and then open the floor for questions. So I'm going to just take selective slides from this presentation. And I think the most common question on our mind is essentially ki, are the markets cheap or expensive? So while we talk a lot about earnings and GDP and all that, I think long term, if you want to see how markets are valued, it is good to look at what we call real return. Real return is basically key equities has given how much above inflation, because generally it is seen across different markets that the real return of equity always converges to 5 to 7%, meaning if a country has inflation of let's say 2%, then equities tend to return about 7 to 9%, which is 5 to 7% above inflation. So if you take US for example, basically if you see this chart and you see time is on the horizontal axis, so the longer time frame you measure, the real return always comes to 6.5% in US. For Japan, it is 5.5%. For India, also, it is roughly 6.5% over the long term. So, this is a good way to see long term how to allocate assets to equities. And if you see India's chart on this, the Nifty 500, the 10-year real return is slightly expensive today. It's about 8.5% versus the normal 6.5%. But if you take even longer time frame of 20 years, it is exactly in line with average return, which is about 6.5, 6.8%. So summary of this is from a long-term perspective, which is how we should allocate to different asset classes. We can say that today equities is almost perfectly fairly valued. Now, I know it's a bit of a boring stance, but data is data. So we don't think when 20-year return is exactly in line with where it should be, there is any reason to be very greedy or fearful from a long-term perspective. Now, you can make the case that generally equities में correction आता ही है, तो why I should own equities when it is fair value? I should wait till there is distress value or deep value, which is I think a valid point. But only thing is we feel that we are living in slightly peculiar or strange times globally, and that environment is good for what we call risk assets. Risk assets are generally gold, silver, real estate, equities, which can protect you against inflation because there is inherent demand or supply when inflation is high for these kind of assets versus something like just sitting on cash or putting in fixed deposit for 1 year in a bank. Now, why we think like that is basically, as I said, we are living in a very, very strange time where governments have taken huge amount of debt. Virtually every developed country today has debt which is more than its GDP. So as a percentage of GDP, typically when the debt crosses 100%, that is a red flag. That is a very extreme kind of situation. And typically post World War, we've not seen this kind of debt. So why this is important is if we take the example of Japan, which today has the highest level of government debt, it crossed 100% early 2000 and today it is almost 250%. Um, and the way it has behaved, we think gives you an idea of how rest of the countries which have the same issue are going to behave. Essentially, Japan had very high government debt and low real GDP growth because of demographics, meaning its population is aging, it has almost peaked out, so number of work people in the workforce have actually started decreasing. So that there is a demographic problem and there is a debt problem. So if you see last 20-25 years, essentially the way Japan has managed its government debt is basically by keeping interest rates very low versus inflation, what we call negative real rates. That is, today, for example, inflation in Japan is 2.5-3%, and short-term rates are zero. Even the 10-year yield is 1.5, 1.7%. So if you keep cash or keep money in the bank, essentially you will not be able to save your purchasing power because you will not be able to beat inflation. And the other aspect of this is because the debt is high, the bond issuance of the government is high. The Central Bank of Japan has kept buying lot of government bonds to the extent that almost 40 to 45% of entire debt of Japanese government is today on the balance sheet of the central bank. So what we call quantitative easing or monetizing debt or central bank helping the government by buying bonds, whatever words we can use, essentially in Japan, this debt has been inflated away by keeping interest rates low and by the central bank buying these government bonds. Now, if you see what happens after that, basically the currency takes a knock. So, over the last 25 years, the yen has fallen 90% against gold. A good currency like Swiss franc, it has fallen 60%, and even against USD, which has its own problems today, it has fallen 30%. Um, and clearly, we will see that a risk asset like equities over last 10 years has given 10% even in a very low growth country like Japan. Uh, Whereas inflation has been 1% and 10-year yield is only 1.5%. So the moral of the story here is when governments have a lot of debt, they can think of various choices, but politically it is very difficult to do it the hard way, which is either cut expenses of the government or increase taxes. So typically, the easiest choice for governments is to reduce interest rate below inflation. If you see, even in US, when Trump came in, there was this initiative called DOG, which was to reduce government expenditure, but that did not take off, which is usually what happens, especially in democratic governments, when government expenditure has to be cut because of various vested interests and bureaucracy, it's not possible. So what we think happened with Japan is likely to happen to a lot of the other developed countries which have the same issues. They have very high debt and very big demographic challenges. Um, so we generally think this is an environment where risk assets, which is gold, silver, Indian equities, global equities, uh, all these will do well. And obviously, if a country has good macro stability, we will get foreign capital finally. I know this has obviously been a year where a lot of the FIs have kept selling, but I'll come to that. But in general, any good hard asset where uh, either the currency is good or the asset has a long shelf life, I think those assets will keep getting valued more and more. So from a domestic viewpoint, actually, our fundamentals are very good for the currency. As we have talked before, our current account deficit has structurally come down because oil has come down. So oil imports used to be 7-8% of GDP, which is the graph you see on the top. And our service exports have done well post COVID because of a lot of these global captive centers opening up in India. So you will see that our service exports from 2.5% have gone up to 4.5%. And therefore, our current account deficit has come down. Apart from that, not only is our inflation low, but our volatility of inflation is also reduced a lot. Why it is important is just like if a stock is less volatile, it should get higher valuation. If a country has low inflation, also with low volatility of inflation, then its rating in terms of credit worthiness should go up. So we have had both, and the third positive is also that with the recent run up in gold, the household balance sheet has improved a lot. So roughly speaking, over the last 2 to 3 years, there has been roughly 2 trillion value of gold which has gone up in household balance sheet. So in 2022, it was roughly 1.8 trillion. Today, it's about 3.5 trillion. Um, this is very, very big because if you think about it, this is roughly about 300 to 350 lakh crores, which is almost double of what Indians households have as bank deposits. So roughly Indian households bank deposits is roughly 150 lakh crores. And today the market value of gold owned by Indian households is more than double of that, almost 350 lakh crores. And while obviously Indians are very reluctant to transact with gold, but if you see gold loans, for example, that is one way in which this big wealth of gold is being used to help businesses or individuals to either consume or produce. So while it is difficult to get data on unorganized gold lending, if you just look at organized gold lending, that also has shot up quite a lot. If you see banks or NBFCs exposure to gold loans, that is growing at almost 50 to 100% at a system level over last 2 3 years, and that is obviously helping economic activity. Now, generally, as a structural call, we've been more positive on small caps versus large caps. And briefly touching upon the logic of this, first of all, as I said, with Japan, today every country has demographic issues. Most of the countries today are peaking out in population. So in this graph, anything which is not blue is basically a country which has challenging demographic issues. And even in India, if you see, while at country level our population is stable, but a lot of the richer states, which tend to be in south and west, their birth rate is much below 2, which is needed to replace population. So you will see in next 5 7 years that most of the south and west states will peak out in population. In fact, the number of children in India schools is actually started degrowing already. So today the number of children in Indian schools is actually less than 2019. So that demographic peak is close by. Another issue is free trade also now is facing challenges, which was helping global growth. So we all know that tariffs, etc. They have gone up a lot, which will hinder global growth. So, first of all, again, if you look at history, mid and small caps generally outperform in most markets if you take a long enough time frame. So, if you look on 100 years, 20 years, 10 years kind of time frame, in most countries, mid and small caps outperform. Also, we think large caps, they're good for defense and in a volatile time like this calendar year, but unlikely that big earning growth is going to happen in large cap purely because if you see the large cap earnings are kind of tied to nominal GDP over the long term. So if you take last 25 years, broadly nominal GDP has been equal to Nifty 50 earnings. And today, over last 5 years, we are coming off a base where Nifty earnings has generally been very healthy versus nominal GDP. So last 5 years, Nifty earnings, of course, from a very bad COVID base, but still 5 years, 20% CAGR over nominal GDP, which has been 10%. So from this high base, unlikely that we are going to see any big earning growth in large cap. Um, so generally, we feel that if liquidity is high, as I mentioned, because governments are going to run low interest rates and loose monetary policy, then selectively, if we are able to find smaller stocks which can grow at 15-20% for longer period of time at a good valuation, I think given the wide choice in small caps, a good selection of small caps can outperform earning growth of large cap and therefore do better in terms of price performance as well. Now, coming to risk factors, I think one is globally the long term yields are very high, especially the 30-year yield. And ultimately, unless this 30-year yield globally comes down, it is difficult for equities to perform because in many countries, this 30-year yield is very, very high. So if you see US, it is 4.7, UK, it is 5.3, in Japan, it is 3.3, which is very high compared to the 10-year yield or the 2-year yield. Even in India, there is a big gap between the 10-year yield and the 30-year yield. And if the cost of opportunity cost, see, people will compare 30-year yield with equities, and if the 30-year yield starts generating a lot of return, then the need to be in equities will not be there. Uh, in general, we believe that the governments will incentivize central banks to buy these bonds and get these yields down. But if that doesn't happen, then I think globally it will be difficult for equities to do well if these yields don't come down. So this is at a global level. I think at an Indian level, we are living through a very kind of perfect storm for Indian rupee. Uh, See, typically pressure on currency can come from two sides. One is current account where the exports are falling short versus imports, which we saw in 2009 to 11 in India, because at that point India's current account deficit used to be 4 to 5% of GDP. Um, this is a different paradigm where the pressure is coming from the capital account. And this is a bit more difficult to predict because current account usually once the rupee or any currency depreciates a bit, the imports become expensive, the exports become more profitable, and generally the gap the trade deficit closes because people start importing less and exporting more. So if a big trade deficit was there, then that gap reduces as the currency goes down. Uh, Capital outflows are a bit difficult to predict because they move on sentiment, narrative, and generally tend to be pro-cyclical rather than counter-cyclical. So today, obviously, we are seeing that a lot of FDI holders and FI holders of Indian assets, they are liquidating those assets. Um, Probably because they see liquidity in the Indian markets as very high and as opportunity to book profits. Uh, the other related thing is also that Indian households are buying a lot of gold and silver, which are obviously again being imported. So between stocks and precious metal like gold and silver, essentially, in a way, these are capital outflow things, which is putting pressure on rupee. The current account by itself marginally has deteriorated from maybe less than 1% to today about 1.3, 1.5%. But very, very disciplined versus, as I said, in 2000 to the 13, it used to be 4, 5%. Uh, but the issue is that a lot of factors are leading to capital outflows. See, one is, of course, the US-India trade agreement, which is not so important from a pure economic perspective, but obviously from an investor sentiment perspective, from a perspective that the risk premium of India goes up if the deal doesn't happen. That has been getting delayed again and again, and that has got a big role to play in this currency issue. Second is, um, as I said, the amount of gold and silver buying by Indian households is actually quite unprecedented. So, for example, in October, there was $14 billion of gold purchases at a country level, which is a very, very big number. Usually, the annual purchase of gold is in the 30 to 35 billion dollar. And even in November, though it has come down a lot, but still it was 4 billion. So in the last 2 months, October and November, there's been roughly $18 billion of gold. And I think silver, I don't have the numbers, but that also, if you see the silver ETF, the inflows and all have gone up quite a lot. So between FDI, FI equity, gold, and silver, we clearly are seeing a lot of imports. And honestly, I don't think you can put any milestone at which this will reverse. Of course, at some point, the rupee will become very valuable or value for foreign investors to jump in. But whether that will happen today or at 92 or 94 is very difficult to predict. Because as I said, see, current account, you can you can have a estimate of fair value of a currency because at some point the trade deficit will bridge. But here, the trade deficit is not as much an issue as the asset narrative that gold, silver, stocks, everything seems to be attracting a lot of money at this point of time. So we'll have to see how this plays out. And clearly, from a portfolio perspective, I think you need to hedge and be in export stocks or dollar stocks so that while the storm is on, we kind of don't underperform too much. From a domestic liquidity perspective, structurally things look fine. This data is a bit old, but today equities is still a small part of the overall household balance sheet. As I said, gold today on updated prices will be about 350 lakh crores. Um, and also, we think there is a lot of money lying in savings account and term deposits of banks, which is not earning much. So we already seeing that savings account there's almost 70 lakh crores lying in Indian banks, which is started to slow down, which means that I think people are shifting to, if not equity, at least some hybrid products to get better returns. So we do see this as a big tailwind for um, domestic flows. So overall, if I have to summarize our market view, the long-term indicators, which is real returns, suggest that on a 10-year basis, market is slightly above fair value. On a 20-year basis, it's exactly at fair value. And given the global context of loose monetary policy likely to continue, we generally don't think it is advisable to under-allocate to equities. Uh, I think the US-India trade pact is important. Unfortunately, it's got delayed, but maybe that is the event which the currency markets are looking for. Otherwise, if you leave apart that, most of the macro things have been quite positive. The dollar is, while it's not falling, but it's not hardening at least. A lot of Asian currencies have done well versus the dollar this calendar year. There is fiscal stimulus. RBI is dovish. Europe is also doing stimulus. Gold prices, which help household balance sheets, are going up. Crude is going down. So overall, on the normal macro side, nothing much is a concern at this point of time. Incrementally, and I know a lot of times over last 3 years, people have predicted that US will slow down or go into recession. Even with these trade tariffs coming in, there's not been too much of slowing down of US economy, but still, the trade tariff still has to play out through the supply chain. And interest rates have been high in US. The 30-year yield, which based on which the mortgage rates are set in US, is still quite high. So there is a chance that US economy slows down. Also, the AI capex, which has driven a lot of strength in US economy recently, there are clearly some doubts about how viable that is from a profit perspective. And if that takes a knock, there is obviously risk that US will slow down. But if we just, instead of focusing on near-term things, our structural view is that we live in a world with low global growth, and that obviously also means India's growth will be limited. There is very high technology disruption and very high liquidity given the high government high government debt. So for long-term investors, if you're looking for high earnings growth, which will translate to healthy returns, I think you will have to typically go down the market cap curve through small cap or thematic products like innovation or financial services. Because large and mid cap stocks generally are good quality, stable stocks, but there's unlikely to be very high earnings growth there. Um, However, if you're looking at 3, 6 months, honestly, we don't think any big return is going to happen in the market because if not for anything else, leave apart the macro and all that, just the supply of IPOs, QIPs, private equity selling, promoter selling. Just the supply of paper is very high, and I think what we are going through is very similar to what happened from October 21 to March 23. It started off as a global macro issue because Fed increased interest rates, and then with the supply of paper and all, it took time for the market to digest all that. Um, I think something similar is happening. We have some macro issues. We had India-Pakistan war, the US-India trade agreement has got delayed. All those issues are there, but it's also just that a lot of bunching up of supply is there, and therefore, till valuations correct a bit, till that paper gets absorbed, and maybe there will be some instances where some IPO will fail, which will typically mark, the reduction in supply. Till that time, I think the market will broadly be in a consolidation range, and therefore, um, if people have a shorter time frame, then I think hybrids are a good way, multi-asset funds or BAF. But yeah, for people with 3 to 5 year perspective, I think small cap, innovation, financial services, those are good products to look at.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.